What's going on? Welcome to my channel. I'm the cover call guy, and my goal is to create $120,000 per year passive income. My portfolio currently yields about $70,000 a year and about $6,000 a month using only cover call ETF. Legal disclaimer before we start this video: this content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. I'm just some random idiot you found online, and I could be completely wrong. Today's video is going to be a fun one. I got the idea that I might actually turn this into a whole series, right? Um, I think a few videos ago I did expense ratios, and it kind of triggered a idea brainstorm in my head saying, hey, maybe I can do an expense ratio on all of the cover call ETFs, fund by fund. Today, we're going to do just that using YieldMax. And I think I did most of their, if not almost all of their ETFs and stocks, if not then the majority. It was a lot to go through, but I kind of just picked out the most popular, most well known, and I guess invested like in the UMax community. So let's get started. Expense ratio wars. This might be the first video of the series, so that's why I kind of named it like this. Audit of YieldMax option income ETFs. A quantitative deep dive into the NAV erosion, tax inefficiency, and the 0.99% question. Is it worth it? All right, the new landscape of active income, right? So the expense ratio war, the shift, historically a race to the bottom for passive fees, 0.03%. Now a new front has opened for active derivative income where yields justify premium fees. The core question is, are investors overpaying given the complex risks involved? The total cost of ownership, TCO for short, if you see in the other slides, is not just the expense ratio. It is explicit fee, explicit bid-ask spread, tax inefficiency, which is ordinary income, and structural NAV erosion. So we have to look at all of four and kind of combine it to really make sure, is this expense ratio worth it? All right, the cost mechanics, right? The fee burden. Explicit cost on a hypothetical $10,000 investment, assuming the standard 0.99 expense ratio from YieldMax. The daily cost is about 27 cents extracted from the NAV daily. Monthly cost is $8.25, and the annual cost is about $99 that you guys are paying, or all, not you guys, but the investors who are investing into YieldMax. This is what you're paying on daily cost, at the monthly cost, and at the annual cost per $1,000 invested into whatever ETF or stock. So you have $100,000, then just times 10 to daily, monthly, and annual costs. While a 27 cents a day sounds trivial, it is charged on assets under management, creating a trap when assets shrink. This 0.99% is the admission price before structural costs. So this is what you pay up front right away before anything else happens. The shrinking base trap. NAV erosion math and high erosion funds like TSLY, the share price has dropped about 50% since inception. Year one, you invest $10,000, pay $99 annual fee. Year two, NAV drops to $5,000. Fee is $49.50. The trap: to recover $10,000, you now need a 100% return on the remaining $5,000. The 0.99 fee acts as a constant headwind against this massive recovery. Right? And a lot of people don't actually know the recovery formula. A 50% loss requires a 100% gain. A 75% loss requires a 300% gain. Just to break even. Just so you're at the break even price. This is what you need. Pretty insane. A lot of people don't actually know this. What behind? They think, oh, it dropped 5%. I just need 5% for it to go back up 5%. That is false. 100% false. A lot of people just think that way, but the math behind it is actually very, very different. TSLY investment audit, right? It's pretty much the underlying of Tesla. Hypothetical $10,000 invested in November 2022. Scenario A, no reinvestment, because I know some of y'all gonna say, "Oh, reinvested, don't I put money back in." So I'm gonna do no reinvestment and reinvested. Scenario A, no reinvestment. Principal remaining 3,500. Cash payout 5,500, which is taxable. Net result, wealth destruction $9,000 total value versus 10K initial. Was it worth it? Now you're gonna say, "Oh, but I reinvested." Well, if you did, the ending value was 12,300. So you are up. Net result positive, but barely beat inflation after taxes. Did you win? Did you really win? Because if you're investing in income stocks, why are you reinvesting all of it? Because this is assuming you reinvest all of it. Because I'm not going to go, 10, 20, 30, 40, 50% here. Then that means it would be much lower. Much lower. This is 100%. So I can show the case where you're net positive, barely, but you didn't survive off of it. So I don't know. And what was the point of investing in this? Right, the structural flaw, my verdict, you're overpaying. TSLY illustrates the danger of applying a capped upside strategy to a high momentum stock. When Tesla rallies 10%, TSLY is capped at 2 to 3%. When TSLA, the Tesla, okay, why did I say it? When Tesla drops 10%, TSLY drops about 10% also. This asymmetric creates a permanent drag. The 0.99 fee was essentially paid to oversee the erosion of 65% of the principal capital. TSLY cost and tax analysis. The cost reality, you paid $250 over 2.5 years as the fee. Tax bill, you're in the 37% bracket. A 5,000 on 5,500 payout. Tax is about $2,000 and $2,035. Almost, just about almost half. Net realizable value, the tax bill exceeded the profit in total return scenarios. My verdict, you are overpaying. Obviously, I can't say scam because it's by right now it's not a scam, right? But I could kind of put that borderline, and I'm not trying to get shut down or sued. So overpaying. Structural mismatch between strategy, means of reversion, and asset momentum. The investor paid fees to oversee capital destruction. You are paying YieldMax managers to destroy your capital, essentially, what I'm saying. NVDY, the exception for NVIDIA. Hypothetical $10,000 invested in May 2023. No reinvestment. Your principal is about 11,500. It grew plus $6,000 in cash. Reinvested, total return over 75%. Ending value about $17,500. My verdict, this is a winner. Investors paid the 0.99 fee and received a substantial alpha. Why did this work? Momentum was greater than capped drag. NVIDIA's underlying momentum was so violent that it frequently blew past the option strike, but the premiums collected were massive, high implied volatility (IV). Unlike TSLY, NVDY experienced positive drift in NAV. The fee here is fair value for the exposure to high volatility premiums. So NVIDIA, the original underlying NVDA, popped so much so quick and kept going up that the premiums collected were just so great that it was not a lose-lose scenario in any way possible. But that can also work against you. CONY, the volatility trap. Coinbase, hypothetical $10,000 invested in August 2023. No reinvestment. Your principal is about 3 to 4,000. A severe drop. Cash payout is about 9,000. Reinvested is about 129% return if timed perfectly. That's the key word here. if timed perfectly. Because I also get comments saying, hey, I invested since inception and I reinvested and I added more, I'm up. Yes, but that is not the majority of people, right? Nobody got in perfectly and it reinvested and added more like you did. A lot of people knew about it 6 months later, a year later, right? Or invested, like I don't know, today, yesterday, right? So they're not going to always be up just because you are. I got a binary outcome from this, right? CONY captures the full crash of crypto winters, but caps the hold upside. It yields 100% annually, but often by returning your own principal, which leads to the tax trap. Ordinary income versus capital loss. Because the fund distribute income while the sharp price collapses, you are left with a massive tax bill on the distribution, but your capital loss is unrealized or limited to $3,000 a year. You owe taxes on money you essentially lost. So yes, you were up if you reinvested, but you were also hit with a huge tax bill plus capital depreciation. Unless you timed it perfectly. That's why I put that there, because there are some people who did make it out, right? Like they got in, got out perfectly, and they made money. MSTY, the speculative win from micro strategy. Hypothetical $10,000 invested in February 2024. No reinvestment. Your principal is now $7,000, down 30%. Cash payout about 8,000. If you reinvest it, you're about 150% annualized return. Ending value about $25,000. My analysis: MSTY effectively liquidated the stock position to pay you cash, is what I think pretty much happened to the majority of the people. My verdict: it's cheap leverage. The 0.99 fee is cheap relative to the 200% plus implied volatility being harvested. It is a speculative tool, not an investment. Be very careful with MSTY. Just buy Bitcoin at this point. Right? Just put your money into Bitcoin. You are pretty. This one is pretty much a gamble. I mean, I love Sailor, but man, that guy. Moving on. I mean, this is just a gamble, right? Like, if you made it out, you made money. Good for you. If you're in it and you're just down and getting beaten, figure out what you want to do with this. You know. I hope it pop back up because I actually know a few people who down bad on this. In real life, I know a few people down bad in this. They kind of put a good chunk of money too. I personally know someone who put almost 200,000 into this, and they're down pretty bad. So I do wish the best for everyone invested in this. Structural failures: ULTY and YieldMax. Oh God, I'm gonna get these hate comments every time I talk about ULTY and and YieldMax. Even if it's in a positive light, I still get the hate comments. Even I don't even talk bad about them. I just talk borderline, non-biased. I get hate comments, but it is what it is. This channel is about the truth, and I'm about the truth. I'm about transparency. I want all of my subscribers to make money. I'm not sponsored. I'm gonna say what it is. ULTY is an active failure. Their strategy is an active basket of high IV stock. My verdict: you're overpaying. The active management is a 1.14% fee. Failed to select winners. No on the reverse splits, because I know people are going to say, oh, what about the reverse split? Blah, 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 blah. ULTY has undergone reverse split. This is a cosmetic fix that raises share prices but does not restore the lost economic value or capital. You can put makeup on a pig. It is still a pig. I mean, I don't know how else to say for these people invested in this. And there was one guy who commented saying he's gonna be up. Good for you if you're still a subscriber and a viewer. I hope you are. Good for you. I want you to make your money back. I don't want anybody to lose money. I've been burned when I first started out. I used to chase the trending memes. I mean, I've been down. I've literally lost realized gains of like at least like $75,000. So I'm trying to make sure nobody, no subscriber on my channel, anyone who comes and views and watch the videos, I hope nobody loses money. But if you're invested in this just for the yield without doing the proper research, you're going to lose money. It's plain and simple, you know, like it's not possible for a ULTY to be fixed just by doing reverse splits. They have to change their actual strategy. YMAX, fee layering. Their strategy is funds of fund. Their fee is 0.29%. Management plus a 0.99% AFFE equals a 100, not 100, sorry, 1.28% total. And I bet people who are invested into YMAX don't even know what an AFFE is. For those who don't know and are invested in this, it is an acquired funds fee and expense, right? It's the operating expense of an underlying fund with a larger funds of funds, or sometimes it's called a multi-manager structure. These are not direct cash costs for the investor, but are included in the total expense ratio of the parent fund to provide transparency about the layer cost of investing in other funds. You're basically paying other people to give advice to the management who then charge you to do this. My verdict: inefficient. You pay a premium to dilute winners and with losers. It is structural erosion as guaranteed by the basket approach. I don't even know why you would pick this. There's so much better choice than YMAX. Much better choice. The tech cohort, right? We can't miss this. Amazon, uh, Meta, Facebook, and Google. For Amazon, my verdict. Okay, let me just. Amazon outcome of 10K invested. The principal 8.5K, cash 4K. Total return is about 30 to 80%. My verdict here is fair value, manageable erosion. And I forgot to put that. Depending on when you got in, a lot of these YMAX ETFs and stocks is really depending on when you got in, how much you invested, how much you reinvested, right? And I just want to say this again. I've commented on a few other my replies. If you There's a difference between reinvesting because you want to, reinvesting because you want to beat inflation, versus reinvesting because you have to. Huge difference here. Very, very different. You're reinvesting to beat inflation is very optional. That's your choice. If you have to reinvest because you have to, or you just lose money, you know what I'm talking about here, red flag. That should signal you to just go, all right. If you're down at least $3,000, just sell out, use the 3K as the tax harvest, and learn your lesson and move on. FBY Meta. If you invested $10,000, your principal would be $8,000, cash $6,000, total return 74%. My verdict: this one is a winner. Perfect backdrop recovery. Didn't do so bad, not so bad. It's okay. It was a gamble depending on when you got in. This is all about timing here. I really should have put that on a slide. It's somewhere on top. It's all about timing. GOOY from Google. If you invested $10,000, your principal is now 10.5K. It grew. Cash 3K. Your return is about 48 to 60%. This one out of the three would be my best value. Slow grind is ideal, right? But you know, these YieldMax products is very, very 50-50. AIYY is the total loss. Absolutely, you got destroyed if you invested in this. Hypothetical 10K investment in November 2023. Non reinvestment, your principal is now about $4,000. Collapsing price, you got paid about $2,000 in cash. If you reinvested, it was still a negative total return. My verdict is that this is one of the worst case scenario. The underlying stock crashed and capped upside prevented recovery. Investors paid fees to lose money. Nobody wants to hear that, but like I said on this channel, for me, I don't really give a damn about having sponsors. I don't care about having any sponsors. I will never ask you for money. I don't have a Discord. I don't have anything else for you to Patreon. If you want to support me, give me a subscribe, like, share the video, because I'm going to tell you the truth. If you like losing money, go ahead and invest in this one. Tax impact, the silent killer. A lot of people don't think about this, right? They think cover call ETFs gives a lot of return of capital. That is half true. More of a myth for YieldMax products, right? The phantom income trap. If you buy at $20 and the price drops to 10, you have a $10 unrealized loss. However, if you receive $8 in distribution, that is tax ordinary income. Remember, about 37%. You owe the tax on the $8. You cannot net this against the $10 loss until you sell, and even then, deduction limits apply. Holding type. YieldMax is ordinary. Tax rate 37%. Your net income from $10,000 investment is $3,780. That is insane. Absolutely insane. So YieldMax versus SP500, which for the most part is qualified. The tax rate is 20%, and then direct stock. This channel is not about direct stock. Well, depending on, for the most part, it's not. Let me think on top of my head. Let's stay on topic. Long-term capital gains is about 20%, and then of course we can talk about ROC, which tax rate could be 0%, and then it's 60/40. But we'll just stick with YieldMax for the most part. Almost all YieldMax do have ordinary income at 37% tax rate. Fund analysis. I kind of try to name as much as possible, and then it got cut off. I couldn't fit it all. There was a lot more. I apologize for that. But I'll just name off a few here. ABNY from Airbnb status. Caution. Primary risk. Moderate erosion. AIYY is a trap. Severe erosion. Avoid. AMDY. Caution. High beta. Tracks TSLY profile. Amazon. Fair value depending on when you got in. I would say it has a solid performance. Apple. Fair value when you got in. It's very defensive. Preserve capital. Alibaba. BABO. I say it's a trap. China risk plus option cap. BIGY from Target 12. At the moment, I want to say it's fair value, sustainable NAV focus, but we have to keep track of it. BRKC from Berkshire. Because it's from Berkshire, I'm going to give it a fair value, very stable, lower yield. Chippy, fair value, and low volatility grinder. CONY, caution. Right, I mentioned the binary boom bust. Well, I have no idea why I put Chipotle here. This is not Chipotle. Why did I put Chipotle? Why did I put Chipotle? Okay, this is a mistake. I don't know why did I put Chipotle? Maybe I was just hungry. But Chippy is not Chipotle. It's semiconductor. It's a basket of a semiconductor portfolio. I don't know why I put Chipotle here. Man, I'm hungry. Anyway, let's get this done. Fund analysis. And the why I kind of got cut off again here, and it looked good on my end when I was doing it, but I guess when I finished it and saved it, it got cut off. So I'm not gonna name it all. You guys can see, pause the video and determine, my take. This is my take on it, right? Obviously, this is gonna be judgmental here, right? I put NVDY, the target 25 at fair, just because I think we should give them some time. They created the target 25 because there was a lot of complaints about NAV erosion. So I'm going to go ahead and give them a fair. I'm going to say they are aiming for better long term. So the primary risk here is going to be short term hold. Is better long term. All right, YieldMax versus the competitors. How do they hold up, right? YieldMax versus Defiance, Kirk, and Roundhill. YieldMax flagships are TSLY, NVDY. The expense ratio is 0.99. Their strategy verdict, legacy, high erosion, target, sustainable. Defiance, QQY, MSTX, expense ratio at 1.29%. Strategy slash verdict, leverage, and 0 date expiration. Higher risk. We have from Curve, flagships, TSLP, AAPY. Expense ratio is 1%. Strategy and verdict, active management, better NAV retention. I think they're not so bad here. They're actually catching up and they're growing their assets under management. So they are kind of the smaller guys right now, but they are kind of getting pretty popular. And of course, we have Roundhill. They're already popular. They're pretty big. They are very, very well known for their weeklies. Their flagships, I think, are XDTE and QDTE, with most of their expense ratio being 0.95. They do a lot of weeklies, a slightly lower fee. So right now, YieldMax is kind of, they're like in the middle, right? But they are known for the NAV erosion. The strategic pivot, right? YieldMax admitted the erosion by launching the target funds, right? The warning here with these legacy funds is that erosion risk, right? TSLY, CONY, NVDY, they're the legacy funds. The mechanic is that they distribute 100% of the option income or even more, which leads to high yield but high erosion. My verdict here is structural wealth destruction without perfect timing. This one, it's all about perfect timing. And this is the new one. Target funds, tickers, TESS, NVIT, MSST, and Biggie. I put all of them at fair value just because right now they're going to be tested. We won't know until we give them at least a year, to be fair. The mechanic is that they cap distributions from 12 to 25%. As you know, they have lowered it, so they are admitting erosion. So they kind of lowered it. These might be their best ones. I think they're launching a lot more. They will be releasing a lot more in the target funds. The result is that I think they're trying to preserve NAV as best as possible. My verdict here right now is fair value and it is sustainable. Right, 12 to 25% is very sustainable. And that's the final verdict. Yes, you are overpaying if you hold legacy eroding funds, right? You pay 0.99% to watch principal evaporate. Yes, on structure, if you hold YMAX, YMAG, 1.28% fee. No, it's fair value if you own NVDY, GOY, MSFO, value delivered, of course, with the timing. And no, it's improved. They have launched funds that are trying to, catch up and start actually competing against their competitors with the target funds as TEST and NVIT, like the previous slide. And I just wanted to put a quote here that I found online. The real war between yield and NAV, the 0.99% fee, is merely the admission ticket. So understand if you actually want to buy the ticket to get inside, because you might not like it and you might not be able to get out. Subscribe, comment, like. Thanks for watching the video. If you guys really, really like this, I'll do a actual erosion series of different funds and see if it's overpaid, underpaid, fair value, excellent. This just kind of popped in my head when I was doing the erosion videos, and I was like, wait, maybe I can turn this into an actual series. I don't know. If you guys like it, let me know. I appreciate you guys watching. Subscribe, comment, like. I appreciate all of it. Hate, love, everything. And catch you guys on the next. Stay tuned.